Good morning and welcome to Stock Market Today. It is Thursday, June 11th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider that hit your inbox every trading day before the market opens. So back at it after a day off yesterday that saw U.S. equities finish mostly lower. Treasuries were stronger across the curve. The dollar was weaker again on the major crosses. Gold was down 10 basis points and WTI crude finished up 1.7%. Big news of the day was comments from Chairman Powell, which indicated that fallout from COVID-19 continues to pose risks to the economy and that the Fed is likely to keep rates low through 2022. At the same time, media reports are starting to pick up that we're beginning to highlight the possibility of a second wave of COVID-19 after an increase in infections has been reported in several states. These dynamics led to early signs of some profit taking in the cyclical areas of the market that have been strong over the past few weeks. And at the same time, a rotation back into growth caused the Nasdaq to trade to a new all-time high. As we get to the desk this morning, S&P futures are down about 1.5%, but off the worst levels of the morning. Asian equities were weaker overnight, with Japan, Australia, and Hong Kong lagging. European equities are under pressure as well. Treasuries are rallying, with the curve flattening. Dollar is weaker against both the yen and the euro. Gold is up 1.1%. Crude oil down 3.5% after posting solid gains in the prior two sessions. So if we take a look at the structure of the S&P 500 here, we can see that we have a near-term pullback as Powell signals a slow path to growth. I think that was the key driver yesterday. We had the unemployment report last week that showed that surprise increase in jobs. And now, that started to get people excited. That started to add some gas to that rotation trade. And it appears that in the near term, Chairman Powell has thrown some cold water on that notion. Now, I would not be surprised to see a pullback. Remember, we've been talking this week about the potential for a pullback and what we'd like to see. And what we'd like to see is initial support hold in the 3,000 to 3,100 area. And if that gives way, secondary support in the 2850 to 2950 area, we'd love to see that hold. As I said earlier this week, that would keep the structure of this uptrend off the March 23rd lows intact and would keep the February highs in play if support holds. That's the key if here. Right. There are times I think we feel compelled to always be doing something in the market. Right now, I think the thing that you should be doing in the market is, if you've been long and you have individual stock positions, is making sure that your risk management process is in place. Because if we do begin to roll over here and break support, you're going to want to have that layer of risk management in place, especially in light of the fact that we are overbought in the near term based on 13 period CCI. And then on top that, we can see that Chaikin money flow is bullish. So indicators are mixed. Market appears to be pausing here in the near term. We want to keep an eye on the key support levels, right? In particular, 3,000, 3,100, to really keep things intact from a trend perspective. Otherwise, you have to start thinking about the possibility of lower and start identifying where we could go from there. That's that kind of, adjusting of your probabilities as the facts change. And I think we're kind of in an area now where we need to be paying close attention to that potential dynamic. Looking at our market in a minute now, what are we writing about? Well, the Nasdaq traded to a record high as other markets pulled back. We talked about that. Chairman Powell speaks to a slow recovery, and he's keeping rates lower for longer. We hit on that already. We're starting to see early signs of a second COVID-19 wave. And I think that was a secondary data point to weigh on equities yesterday. Breadth metrics are stable, but some are flashing a warning in the near term. And as I said, futures do point to a lower open here today. So let's take a look at the major indices from a power bar perspective. The Dow losing 1.3% yesterday. Power bar back to a neutral stance, 4 bulls to 4 bears there. Remember earlier this week, this one had ticked positive. S&P 500 gives up 70 basis points, 109 to 73 bulls to bears there. Nasdaq, record high for the Nasdaq, up 1% on the day, bucking the trend, right, as investors rotated into really what's been working for the better part of 2 years now. 36 to 4 bulls to bears there. Small caps trying to get going from a leadership perspective, but dealt a blow yesterday with those comments from Chairman Powell. Down 3%, 686 to 224 bulls to bears there. Flight to safety sends bonds higher, yields lower. Actually, a potential for a false breakout on the 10-year yield. Technology was your leading sector on the day. Makes sense with the Nasdaq trading higher. Tech up 1.5%, 19 to 2 bulls to bears there. So bigger picture, according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes across the board, however, are mixed. Now, sticking with this theme that I've been running with on Thursdays, where as opposed to having a stock, actually just running a screen based on what I'm seeing in the marketplace. So if Chairman Powell's comments have begun to serve as a rotation back into, or a catalyst for a rotation back into the growth areas of the market, because economic growth is going to be slower for longer, I think it makes sense to run a screen and have a list of growth stocks available. So what I've done here is run what we call our classic bull screen. Classic bulls are very bullish or bullish stocks that are in uptrends with strong money flow and strong relative strength. In particular, the persistency of money flow and relative strength being high over the past 6 months. So what I did was I ran this screen on our growth stock universe, and it returned 24 names today. Now, do you run out and buy all these stocks? No. But I think it's a great starting point to build a watch list, monitor for entries that fit your time frame, entries that run along some of the process that we talk about here day in and day out, week in and week out. But you can see some of the names here. I mean, obviously, these are kind of long-standing market leaders, right? Adobe, Microsoft, Netflix, NVIDIA, Synopsys in the software space that caters to semiconductors, right? Over the past couple of weeks, we've been highlighting names in the gaming space. EA, Take-Two, you see Activision on this list as well. So I think it's always important to maintain a watch list, and that is why I'm kind of bringing you these screens every Thursday. Hopefully you're finding them helpful. I've been getting a ton of great feedback on this aspect of the show. Turning now to our sector tracker, the movement in the major sectors over the last 5 days. Tech vaulting to the top of the list with that strong performance yesterday. Energy still in the number 2 slot, but I wouldn't be surprised to see some profit taking there, as well as in the industrials. Comms, again, one of those longer term leadership areas of the market. The one long-term leadership area of the market that hasn't quite gotten into gear yet is healthcare. Now, utilities, it's kind of surprising to see the utilities fade here, given that there is a bit of a flight to safety in the marketplace, but they are at the bottom of the list. We don't kind of fight what is, we just pay attention to what is and try to position accordingly in the themes that are likely to persist. Now, middle of the road, discretionary fins, staples, and REITs. Materials, would expect them to start to come off as well if the rotation trade is in fact unwinding. Turning now to our industry in focus, it's insurance services, which, I mean, it's been a dog over the past 6 months, lagging the S&P 500 by 16.25%. However, that power bar ratio, which signals future potential, is bullish, right? 19 to 7 bulls to bears there. It's currently ranked number 12 of 21 subsectors, having moved down 5 slots over the past week. So some names there that might be worth a look: American Equity, AEL, CNO Financial, CNO, and Unum Group. I'm not sure if I'm saying that correctly, but the ticker symbol is UNM. All of those stocks have very bullish Chaikin Power Gauge ratings. The fund itself is, kind of, it's hard for me to get excited, to be quite honest. It does have a neutral ETF power gauge rating and a strong trend above the long-term trend line, which is shifting from declining to flat. But money flow is still bearish. The fund is overbought here in the near term, and it continues to be an underperformer. Now, the intensity of underperformance has been diminishing of late, but I think this one needs more time. I'd love to see a pullback that holds kind of the 28 area right around the long-term trend line to kind of be a signal that we could be starting the next wave higher for this particular group. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers. APTV did a capital raise, stock higher by 11%. IDXX, nothing company specific. Same with Salesforce.com. Those stocks up 6% and 4% respectively. Microsoft up 3.5%, hitting a 52-week high yesterday. NVIDIA NVDA up 3.5%, also hitting a new 52-week high yesterday. The loser side of the board kind of looks like a reflection of Chairman Powell's comments that the recovery could take a little bit longer than had been expected. Norwegian Cruise Lines down 14.5%, Gap down 11.5%, ADS down 11%, does have a bullish rating. Kohl's, KSS, another one of the retailers, down nearly 11%. Carnival Cruise Lines, part of that kind of opening or reopening trade, down 10.5% on the heels of Chairman Powell's comments yesterday. Let's dive in now to the charts. So the Qs reached a new all-time high yesterday. The Invesco QQQ Trust just going out at another all-time high. It looks like the third or fourth day in a row that has been the case. It's overbought here in the near term, looking at that 13-period CCI. But what we can see is the relative strength based on that scooter rating does remain solidly bullish, right? Strong leadership here above the rising 50-day moving average, above the rising 200-day moving average, as this group continues to outpace the broader market. And that kind of makes sense. If we are going to see a rotation back into the growth areas of the market, we would certainly expect the Qs to remain market leadership. So far, that does appear to be the case. We've been highlighting in our notes key data points and technical aspects of the market, which would highlight if the rotation trade has legs. A lot of those are at key levels right now. So I think the next couple of days to week and a half are going to be telling as it relates to this rotation trade. So something that we are monitoring and keeping an eye on very, very closely. What about the Russell 2000? This one's breaking a key level, right? IWM has been a participant in that rotation trade, right? As people started to price in the prospect for maybe a little bit of faster growth, they started gravitating to the small caps. And that's interesting, right? As you see relative to the S&P 500, bouncing along the bottom, finally broken out. The key will be holding this breakout level on a relative basis. Now, in absolute terms, we are breaking back below the 200-day moving average. It was below it yesterday. Pre-market trading for the IWM has it trading down here around the 140, 141 area. So a break of key support in the near term for the Russell 2000 as it is in an overbought condition. So again, this is one of the data points that we are highlighting for the rotation trade. If the rotation trade has legs, if the rotation trade is going to continue to gain traction, we would expect to see small caps continuing to outperform. So on a relative basis, getting close to that key breakout level, on an absolute basis, kind of fading here from this congestion that marks trading for the majority of 2019. So just something to be aware of, something to keep in mind as we watch how the rotation plays out here in the days and weeks ahead. And finally, looking at market breadth. Breadth remains strong, but it's extended in the near term. The percentage of stocks above their 200-day moving average got close to 70 before pulling back yesterday, still holding above that 50% level. That signals that a majority of stocks are in long-term uptrends. Ideally, we'd love to see this metric above 60. That would signal to me that a healthy majority of stocks are in long-term uptrends. So just something that we're going to have to keep an eye on here in the near term. In the intermediate term, percentage of stocks above the 50-day moving average at 96%. To me, this is up near 20-year highs. And that does appear to be extended here in the near term. Same goes for the percentage of stocks above their 20-day moving average. So short-term trends still above 90. And what's interesting that I've been highlighting in my note for the past couple of weeks is that it is diverging with price. It's not making higher highs as the index has continued to move higher from that March 23rd low. Not much of a signal from the advanced decline line as it continues to trade in gear with the broader equity market, in particular the S&P 500. So that'll wrap us up for today. Take us for a test drive. I will be back with you tomorrow.